Hey guys, Ken Calcutt here, founder of Cornerstone Financial Management. This is the beginning of a video series that we're going to put out just to give you guys some updates on the markets, what's going on in the economy and the financial world. We'll try to put one out every month. This will be the first one. What I want to do is give you an update. 2022 was a rough year for the markets. Pretty much everybody knows that. What we're dealing with is the Federal Reserve is trying to get inflation under control. We know inflation got out of control last year, 9% inflation rate last June. The Federal Reserve started actively raising interest rates last year in an effort to bring down inflation and slow the economy. Stock market and bond market did not like that. We saw negative performance on both. So where we are today, we feel like the stock market is fairly neutral. I don't feel like the stock market is overpriced anymore. I don't feel like it's underpriced. I think it's about a neutral rate. So the losses last year, the drops in the market, was more of a factor of the stock market getting back to reasonable valuations is what I might call it. Now going forward, there's a lot of question marks. There's a lot of talk about a recession. We may very well have a recession this year. There's some clear indications that might be the case. The bond market and interest rates are clearly signaling a recession is likely this year. The stock market is not necessarily signaling that. We've had a nice little rally in the stock market since October, and here we are in late February, and we're seeing a pretty nice return from October, but that could be more optimism than fundamental. And so what we're looking for is the Federal Reserve is going to continue raising interest rates. The big question is we just don't know how long. We think they're going to go to around 5% for the Fed funds rate. That's kind of what the bond market and the stock market have priced in, 5%. If they go higher than that, we would likely see the stock market go lower and the bond market a little bit lower. We simply won't know what they're going to do until time plays out. We're pretty sure they're going to raise interest rates again in March. They're likely going to raise rates again in May. Beyond that, we just simply don't know. What's likely to occur is the Fed needs to see inflation get below 3%. That's their target. They want it at 2%. I think that's going to be a stretch for them to get there, but that's their goal. They're going to need inflation below 4 to 3% for them to feel like they've made the progress they want to make. And I think they're going to keep raising rates until we see unemployment start to go up. So when we see those numbers, when we see unemployment start to go up and we see inflation getting below 4, I would expect we'd see the Fed start saying they're going to pause rate hikes or maybe even start cutting rate hikes. That's the point where I feel like the markets would be stable going forward and we might be setting up for some reasonable growth going forward. So I don't expect that in the next few months. So because of that, we've kind of defensively positioned investment accounts for the most part. Typically, I like to be more growth oriented and try to maximize the growth potential of a portfolio. But right now, I feel like, the easiest path for the markets right now is probably lower, not necessarily higher for the short term, and because of that, we've defensively positioned portfolios to minimize losses if that is indeed what happens. So what we're looking for unemployment rate to go up. We're looking for inflation to get below 4, the Federal Reserve to stop raising interest rates. When we see those things line up, I feel like we're probably at the bottom of the market and the bottom of this correction, if you will, and we have a good kind of runway for things to improve going forward. So that's generally what we see. That changes by the week these days. The information out there's so much changing. We're constantly monitoring it. We've got a lot of political issues going on, geopolitical conflict that's potentially flaring up. We've got debt issues that are flaring up this year. So there's a number of things that could change the dynamics of the market, and we just simply don't know what they're going to be until things unfold. So for now, the intention with investment accounts is to stay more defensively positioned until we start to see things line up where we're set up for better growth going forward. So we'll continue to keep you updated as we make changes to portfolios and what we see in the markets. But I just wanted to give you a quick update. If you have any questions or concerns, feel free to reach out, email, or call anytime. Thank you.